I'm here to talk to you today. My hosts and I selected a presentation that I'll use to kick off today's session entitled Investing in a Low Return World. And hopefully you might find some of it interesting, and hopefully it'll set the scene for some good Q&A to follow. And we will have time, so I hope you'll all work on your questions while we speak. What has been the dominant characteristic of the financial environment over the last 10 years? And the answer is low interest rates. Generally speaking, I mean, the all-time lows of interest rates were hit during that period, and interest rates, while having been raised in recent years, are still extremely low. The impacts of that is to raise the discounted cash flow of most businesses, to increase the value of businesses, to provide a wind at the back of many businesses, to encourage economic results, all those things. That's why the central banks of the world lowered interest rates 10 plus years ago to fight the global financial crisis. And of course, it did work. But that has left us with an investment environment characterized by low interest rates, and that's the reason for talking about them today. So I've been saying for some time, I still believe that today the uncertainties are unusual in terms of number, scale, and insolubility, things like geopolitics, et cetera. The prospective returns in many asset classes are historically low because of the low interest rate environment. Asset prices range from full to high, depending on which asset category you're talking about, and pro-risk behavior is widespread. They taught me at Chicago 50-odd years ago about the importance of risk aversion in terms of causing the positive correlation between risk and return, and that when people are risk averse, they'll do thorough due diligence and the market will be a safe place. But sometimes they forget to do that. They engage in pro-risk behavior and the environment becomes more risky. The bottom line, I think, has been and is that we're living in a low-return, high-risk world. Some of the environmental indicators over the last couple of years include the 10th year of an economic recovery, the longest bull market in history, the ascendant super stocks, the FANGs, strong demand for corporate credit, money flows into emerging market debt, record fundraising for private equity, the onrush of capital for tech and VC investing, and interest in cryptocurrencies. And I think that these are the important hallmarks of the last couple of years. And what do they mean? We were talking about that before, right? What does it mean? What it means to me is that the markets over the recent years have been shaped by optimism, trust in the future, faith in investing and investors, a low level of skepticism, and risk tolerance, not risk aversion. So the first question is, do you agree? You should ask yourselves, does this guy know what he's talking about, or is he exaggerating, or has he left out a bunch of things to color his presentation? These are the things that I think are reflected in these things. These things have to be present for these things to happen, in my opinion. My point is that attributes like these do not contribute to a positive climate for prospective returns and risk. The increase of optimism, the increase in risk tolerance, the low level of skepticism contribute to asset appreciation. But of course, that asset appreciation does not render the world safer. We have to be cognizant of that. Why are prospective returns low? Again, at Chicago, it all starts here at Chicago for me back in '67. And I learned about the capital market line. And it begins over at the left with the risk-free rate with zero risk. And it proceeds up and to the right to offer investors a potential risk premium as an incentive for bearing incremental risk. That's how the market works. Now, I'm going to take a minute out, since I think I have plenty of time today, to say, you ask most people, what does this slide mean? Think about it for a minute. Ask yourself, what does this slide mean? Okay, time's up. What most people would say, in my opinion, is two things. Number one, riskier assets have higher returns. And number two, if you want to make more money, the way to do it is to take more risk. Everybody agree? I don't get any agreement? Okay. And I think that both of those are terrible formulations for the simple reason that if riskier assets could be counted on for higher returns, by definition, they wouldn't be riskier. So that's a fallacy. And if you are guilty of that fallacy or have been consciously or unconsciously guilty of that fallacy, I think you should check your reasoning. Riskier assets cannot be counted on for higher returns. In my opinion, what this relationship means is different. What it means is that assets that appear riskier have to appear to offer higher returns. They don't have to deliver. So the important thing is to keep that distinction in mind. But anyway, most of the time, the market does look like this. Longer bonds have higher yields than shorter bonds. Low quality bonds have higher yields than safe bonds. Stocks have higher expected returns than high quality bonds, and alternative investments offer higher returns than equities. They merely don't have to deliver. So we get a dialogue, and it goes like this. And let's go back 20 years to 1999. I wrote a memo about this back in 2004. I'm still quoting from it. I've gotten a lot of mileage from it. It's called Risk and Return Today. And what I observed in 2004 is back in force today, I believe. So people would say, well, I can get 4% with no risk in T-bills. If I'm going to buy the 5-year Treasury and tie up my money for 5 years, I need 5%. If I'm going to buy the 10-year, I need 6%. If I can get 6% with no risk in a 10-year Treasury, I need 100 basis points more to buy corporates with credit risk, so that's 7. If I can get 6 in 10-year Treasuries, I'm not going to go into high yield unless I can get 11. And that's the fixed income world. And if I can get those kind of returns on fixed income, I'm not going to buy quality stocks unless I think they'll return 9. NASDAQ, I need 10. And by the way, if I can get those returns from public securities, I'm not going to develop real estate unless I think I can make 14, or go into public private equity unless I think I can make 20, or venture capital unless I think I can make 30. So all along the line, you get people saying, in order to take incremental risk, I need the expectation of incremental return. Nothing could make more sense. And that is the way the world was back in 1999. Then we had this thing called the global financial crisis, and the central banks pulled down the risk-free rate from 4 in 99 to about 0. In some countries, of course, short-term rates went negative in order to stimulate economies, recapitalize financial institutions. And when the risk-free rate was pulled down to 0, everything else followed. And now it goes like, well, if the return on cash is 0, I'm not going to tie my money up for 5 years unless I can get 1. 10 years, I got to have 1.5, and so forth. I wouldn't buy high grades unless they paid 3. I wouldn't buy high yield unless it paid 6, and so forth. So you can see that the demanded returns, all investing is relative. The decisions are relative decisions, and so all of the decisions are still sane in relative terms, but taking place at lower levels in terms of prospective returns. So this is the reason why prospective returns are low today, and this is, of course, as I say, I think the most important single characteristic of the financial environment over the last decade. Now, investors in many markets have taken on increased risk in order to access returns above those on safe assets. So the person who like me, all the money I had in 06-07, I was concerned about the environment, so I took all the money that I had outside of Oaktree and I put it into treasuries. 1, 2, 3, 4, 5, 6-year treasuries. It's called a laddered portfolio for those of you who are in the bond business, and it is the dumbest form of investing known to man. You have this progression of yield of maturities. The closest in one matures, it goes to the back of the line. You always have a portfolio which has 1, 2, 3, 4, 5, 6-year maturities. You always have some money coming due within a few months, and you can't make much, but you can't lose. And the yield on that portfolio was over 6 back in 07. And of course, today it would be over 2. So most people, I meet with pension funds and endowments and insurance companies, and they can't invest for 2, 3, 4%. Many of them need 7 or 8. So that means you can't do much in the low return, safe assets that you used to invest in. So people have had to push out the capital market line in pursuit of tolerable returns in the low return world. That has caused there to be a lot of money chasing limited opportunities in the risk markets, the safe, close-in markets, the government bond market, high-grade bond market, even the stock market, are by definition much larger than the alternative markets of real estate, private equity, venture capital, and so forth, and even private credit. And so you've had a lot of money moving from the safe asset classes to the risk asset classes, and when a lot of money hits a small asset class, we know what happens. And I believe that as a result of the demand for returns, well, let me say this. In February 07, I wrote a memo called The Race to the Bottom. And I said in there that the market for buying investments or making loans is like an auction house. And when an opportunity goes up at an auction house, it goes to the person, the highest bidder. The highest bidder is, by definition, the person who is willing to accept the least for his money. And the same is true of the securities markets. I want to buy some stock. I want to pay 32. Josh says he'll buy it at 32 and a quarter, and Tom says he'll pay 32 and a half. I don't get any. Tom gets the stock. He's the highest bidder. But of course, he gets a worse deal than I would have got at 32, but he makes the investment. The trouble is that when there's a lot of money in investors' hands and they're hot to trot to put it to work, then the bidding maybe goes too far. And in the credit markets, people bid up the price, which means they bid down the yield and they bid down the safety. That's the way the auction goes. And I believe that the race to the bottom has been underway in the credit markets, and that is to say, investors are competing for the limited opportunities in the risk markets by volunteering for low returns, weak structures, and high risk. Again, next question, do you agree or do you not agree? That's, as we go along, that's a question that you should all be asking. So I believe that we have seen over the last few years what I call the 7 worst words in the world: too much money chasing too few deals. And that was the title of my September memo, the 7 worst words in the world. When that's going on, is that going on? Do you think it's been going on? When it's going on, that's troublesome, and you should recognize it and act accordingly. How are high returns achieved? High risk-adjusted returns. How do you get high returns with low risk? The answer, in my experience, is investors make money most safely and most easily when they do things that other people are unwilling to do. That's the history of my career. I started Citibank's high-yield bond portfolios in 1978 when nobody else would do it, and it was considered unfiduciary and imprudent to buy an investment-grade bond. We started the distressed debt fund at TCW in 1988 when people said, "Are you crazy? You're going to buy the debt of bankrupt companies? How can that end?" Nobody else would do it. That's how you get bargains. When investors are unworried and glad to make risky investments, or worried but investing anyway because the low-risk alternatives are unappealing, which is more descriptive of the last 10 years, asset prices will be high, risk premiums will be low, and markets will be risky. That's the result of too much money and investors who are too eager. What will help us avoid the extremes of the markets? And the keys to avoiding mistakes are simple: awareness of history, belief in cycles rather than unabated unidirectional trends, skepticism regarding the existence of free lunches. You know, there just aren't that many opportunities to make a lot of money without risk, regardless of how often they are pandered. Insistence on low purchase prices that provide lots of room for error. And attention to all these things invariably will cause you to miss the most feverish parts of bull markets. You can't have everything, which is when prices go from fair to extreme, but they will also make you a long-term survivor. And I think that's very important. You can't have it both ways. You can't guarantee participation in the appreciation in a heated bull market and be prepared for its reversal. So I wrote my first really cautionary memo of this cycle in July of 17, and I got the rare treat of turning on the TV and watching it being debated. And these are some of the things people said on TV. One guy said the story from Howard Marks is, "It's time to get out." And I said to him, there's only two things I would never say. Number one is get out, and number two is it's time. Because you know, our industry, our field of endeavor does not permit that level of certainty. I would never say those things. And then you can read for yourself the other things that people said about the memo on TV. But I'll read you the last one. And one guy said, "I appreciate Howard Marks's message, but I think now is no more a time to be cautious than any other time." Skip a little. It says, "This means that durable portfolios, hedges, cash reserves, etc., there is no better or worse time for any of these things that we can foresee in advance." That's what he said. And I take issue with all the statements up there now, but most importantly, with the last one. We're all, I assume everybody here is in the investment business. What do we do? What do you do? What is your job? Oh, it's to manage money. No. What is the job of the money manager? And the answer, I think, is that everything we do falls into one of two categories: asset selection and cycle positioning. Asset selection is trying to hold more of the things that will do better and less of the things that will do worse. And cycle positioning means trying to have more money invested more aggressively when the time is right, and less money invested more defensively when the timing is wrong. Positioning for the cycle. Those are the two things we do. I don't think there's anything we do that doesn't fall under one of those two headings. And accepting that there is no better or worse time for defense versus offense means giving up on the latter, tying one hand behind our back. And I think it's a mistake. I think we can, especially at the extremes, increment our performance by being aggressive at the right time and defensive at the right time. There are times for aggressiveness and there are times for caution. When prices are low, pessimism is widespread, and investors flee from risk, that's the time to be aggressive. When prices are high and enthusiasm is rampant and investors are risk tolerant, that's the time for caution. Which is this? That's the question. Very simple question. Not always easy to answer, but a very simple question. Do you agree that sometimes it's better to be on offense or sometimes on defense? Do you agree that these are the things that determine those times? Which is this? Very simple. So, the decision today, these are the questions to ask to try to figure out which this is. Are investments rich or cheap? Where do we stand in the market cycle? That's what the book is all about. How should we be positioned versus our normal risk posture? Every one of you and every client and every institution should have a normal risk posture based on your financial condition, your aspirations, your ability to stand pain, your emotional constitution, your needs, etc. That's your normal position. Where should we be today vis-a-vis our normal position? Should we be emphasizing offense or defense today? Should we worry more about losing money today or worry about missing opportunity? Now, this is very important. Every one of us in this room faces two risks every day. The obvious risk that everybody knows about and nobody likes is the risk of losing money. The more subtle risk, which not everybody thinks about, is the risk of missing opportunity. Now, you could say, Howard, I want to be sure that I don't ever lose a penny. I don't want to ever have a down day in my portfolio. I couldn't take it. I say, okay, we'll put you all in 30-day bills. You'll never have a down day and you'll miss all the opportunities. But if you say, look, I'm a young guy, I have a big risk tolerance, I know what I'm talking about here, I want to make sure I don't miss any opportunities, then we say, okay, no treasuries for you. And now you are 100% exposed to the risk of losing money. So the point is you can eliminate either risk, which puts you entirely at the mercy of the other risk, or you can balance them. And what do most people say? Well, I don't want to lose a lot of money, but on the other hand, I don't want to miss all the opportunities. So I'm going to operate in the middle. I'm going to have some risk of losing money and some risk of missing opportunity. And most of us maintain a balance somewhere in the middle, hopefully as is appropriate for our circumstances and our clients' circumstances. And then the next question is, vis-a-vis your normal balance of the two risks, what should your balance be today? Do you believe in trying to change the balance as the environment changes? Or are you just a buy and hold investor? And it's not necessarily wrong, because changing it is not easy to do. Or do you want to give it a try? And lastly, if you go back 10 years ago, it's a great time to be here, because February 22nd of 2009, if you wanted to make a lot of money, you only needed two things: money to invest and the nerve to invest it. That's all you needed. You didn't need a lot of brains. You didn't need selectivity, caution, conservatism, discipline, patience, agility. All you needed was money and nerve. And if you had those things over the last 10 years, you've made a ton of money. Does that mean that money and nerve is the formula for success in the investment business? No, because if you had money and nerve in April of 2007, you lost a lot of money. You bore the full brunt or more of the global financial crisis. Maybe you got knocked out of business. That's when you needed caution, conservatism, risk control, patience, selectivity, and discipline. So the point is, there are different tools for different climates, which is this: money and nerve today, caution and conservatism today. And Oaktree's mantra over the last several years has been move forward, but with caution. I don't think that asset prices are so high. I don't think the outlook is so bad that you should practice maximum defense. And the return for being in ultra-safe assets is unacceptably low, so for most of us. But on the other hand, I don't think that prices are low enough or the outlook is good enough to be practicing sheer aggression. I don't think there's any place for aggressiveness in today's market. So that's where we came up with this balance of move ahead, but with caution. We're investing every day. We're basically fully invested and trying to stay that way, but with a portfolio that is biased toward defense, not offense. Biased vis-a-vis our norm. So, how should you invest in a low-return world? And I've come up with 6 possibilities. I put them up here, and I'm not aware that there are any others. Number 1, invest as you always have and expect your historic returns. Well, that's actually a fake, because nothing, in my opinion, offers the return that it historically has offered. So that's a red herring. I just want to make sure I had your attention. The second one, invest as you always have and settle for today's low returns. That's more like it. That's more realistic. That's more prudent. It's just not much fun. And for many organizations, it doesn't fit the business plan. The third is to reduce your risk to prepare for a market correction and accept still lower returns, and that's even less fun. The fourth is to go all the way towards defense, go to cash, accept a return closer to zero, and wait for a better environment to put that cash to work. That's very challenging because, going to cash is an extreme action for an active investor. And not only do you have to be right, but you have to be right quick. Because if it takes you 2 years to be right, you'll have dug a hole that if the market keeps going up in those 2 years and you were wrong to go to cash, you'll have dug a hole so deep you may never get out of it. And by the way, you may not have a shovel anymore because you may have lost your job. So that's number 4. Then there's number 5, which is to do the opposite, to take on more risk in the low return world in order to try to get the returns that you used to get with safety. That has obvious merits and demerits. And number 6 is to put more into what you would call special niches and special people. That is, bet more on alternatives, non-market, private, and hopefully skilled managers. Now, the important thing is that none of these alternatives is completely satisfactory. Every one has a downside, including number 6, because you go into special asset classes with what you believe are special managers, and you expose yourself to manage your risk. The risk that you thought you were finding somebody with alpha, but he or she actually turns out to have negative alpha and underperforms. So, as I say, none is completely satisfactory, but I think there are no others. So now let's talk about pursuing superior returns through number 6. According to the efficient market hypothesis, which I was taught here at Chicago, there are no mispricings to find and no such thing as the skill to find them. That is to say, you can't beat the market. You can't have alpha. You can't contribute through active management. And that means that an investor's return will be nothing but the product of the market's performance and the portfolio's degree of sensitivity to that market performance, systematic risk, or what we call beta. Market times beta. Performance is alpha, manager skill, plus beta times the market's return. Efficient market hypothesis is there is no such thing as manager skill, so it's all beta times the market. And if that's true, then the only way to try for a higher return in an efficient beta market is to take on more risk. And for the reasons described earlier, today's beta markets generally offer unusually low prospective returns. You have to decide for yourself whether you accept these as the premises. There are really only 3 ways to strive for high returns in a low return world. Increase your risk, as just described. Rely on getting lucky, or locate inefficient markets where it's possible to profit from alpha or personal skill, and of course, locate managers who have that alpha. The mere fact that a market is an inefficient market, and by the way, I believe that A, there are no markets which are perfectly efficient, and B, there are markets which offer inefficiency. That's the ones we try to work in. But people say, oh, I'm going into XYZ because it's an inefficient market. Merely going into an inefficient market does not mean they hand out money. It doesn't mean that everybody goes into that market and makes an above average return or an above average risk return, risk adjusted return. What it means is that unlike the efficient markets, where there's no such thing as skill or unskill, and as a consequence, everybody performs about the same in the long run, in the inefficient markets, their prices deviate from fair value. So there is scope for a superior manager to do above average through the application of alpha, or an inferior manager to perform below average due to the presence of what you might call negative alpha. So these are the ways to have superior returns. And I believe that in order to participate in active management, which is why I suppose we're all here, who here manages an index fund? Not too many. Okay. So we're all active managers. We all think that we can make value accretive decisions. In order to do active investing, it has to be based on the belief that A, markets exist that are less than fully efficient, that offer the possibility of superior risk-adjusted returns, and B, there are people with the skill to identify the bargains and add value by actively managing assets. If you don't believe both of those two things, then you shouldn't be an active manager. But pursuing alpha is not risk-free. Engagement in active management has to be based on the belief that those two things exist. But pursuing alpha is not risk-free. Inefficiency only means that asset classes, as I mentioned, are able to deviate from fair value, not that they're always bargains. Assets can be overpriced as well as underpriced in an inefficient market. Clients count on alpha managers' abilities to tell the cheap ones from the expensive ones. The potential for choosing the wrong managers introduces manager risk into the equation in the inefficient market categories. Thus, there is no surefire way to access high returns in a low return world, even in alpha markets, as should be expected. One of the underlying beliefs of my philosophy, and I hope of yours, is that most of the time they don't give away money for nothing. That's what the efficient market hypothesis really says. But the question is, will you try? And that's what I wanted to tell you today and kick off the discussion. And that only took a half an hour. So we have half hour for questions if you're loaded. Who's got the first one? Yes. Wait, I think there's a mic coming. Wait a second. Thank you, Kim.
Thanks. Where exactly do you find that line between efficiency and inefficiency in today's asset classes? And how has it evolved with ETFs?
Well, I described my history, which was high yield bonds in 78, distressed debt in 88, emerging markets in 98. So the key is that there were things people would do and things people wouldn't do. There were markets that people didn't understand, didn't have full data on. Maybe there wasn't any performance history. The markets were not fully, they didn't have the infrastructure and the institutions. And of course, there were biases, as I described. There were people who said, no, it's, Moody's, venerable credit rating institution. If you took down the 1978 edition of the Moody's manual off your shelf and you looked up the definition of a B-rated bond, it said, fails to possess the characteristics of a desirable investment. In other words, you cannot prudently invest in a B-rated bond. That's a bias. And if there's an asset and 99% of people will not buy it at any price, then it makes sense that the people who will buy it might get a bargain. So these things, not knowing about it, not understanding about it, not being willing to buy it, not thinking it's a professional or fiduciary, these are the kinds of things that create inefficiency, what I call structural inefficiency. Where are they today? Almost negligible. Today, believe me, 40, 50 years ago, for those of you who were not practicing this profession then, the world was a stupid place. Nobody knew anything. I mean, there was all this data, and maybe the data existed, or maybe it didn't exist, but if it existed, maybe it was over there, and maybe you were over there, and you had no idea where it was, or how to get it, or the people who had it wouldn't give it to you. And today, everybody knows everything. You're out to dinner with your date or your spouse, and you have an argument about when a certain movie came out, you Google it, you find out. There's no such thing anymore as not knowing anything. And so, if today, everybody knows about every asset class, has data on it, and feels they understand it and feels comfortable with it, then where are you going to find structural inefficiencies? And the answer is, it's tough. It's really tough. And so, in my opinion, I wrote a memo in January of 14 called Getting Lucky. By the way, all the memos, unlike the book, the memos are available free. I highly recommend that. And they're all available at www.oaktreecapital.com under click on Insights, and you'll see a thing there about the chairman's memos, or maybe it says memos from Howard Marks. But so I wrote this memo called Getting Lucky, and I talked about a process I call efficientization, which is if inefficiency is really, to sum it up and oversimplify it, inefficiency is the result of ignorance. And today there's much less ignorance. So markets become more efficient over time, and I believe most markets have become more efficient over time. And it's very hard to find anything that is about which there is ignorance. And by the way, back in 1978, people would say to me, well, young man, and I was a young man at the time, I'm sure you can make a lot of money doing that, but it wouldn't be proper. It wouldn't be fiduciary. Now, look around this room. Today, anybody will do anything to make a buck. So that bias does not exist. And that's the bias that gave people like me opportunity 40 years ago. And if everybody's willing to, the economists, we talk about efficient markets, the economy talks about perfect markets. Economists talk about it. And there are certain criteria for perfect markets, which are obviously the same. And one is knowledge, one is objectivity, and one is the willingness to substitute. So in other words, oil and gas will be priced in a standard relationship to each other as long as everybody is willing and able to go from oil to gas and gas to oil. They will equilibrate their prices. That's what efficient markets do. And today, people are willing to invest in any market. So it's really hard to think of where you're going to get a free lunch. However, I do go on in the memo to say that while structural inefficiency is hard to locate, from time to time we get cyclical inefficiency, which is to say from time to time people lose their objectivity and they value assets too low, in which case we can get bargains if we resist the error of their psychology. And sometimes they like assets too much, and the prices are too high, and we can make easy money by shorting them if we can resist the error of the common psychology. So I think it's really hard to find structural inefficiency today. From time to time, we find cyclical inefficiency. And I can't tell you where the dividing line is, and it's never the same. And by the way, one of my, I'll say, competitors came out with a very clever statement about 4 years ago. He said, everything with the QSIP is overpriced today. So what he was saying is that all public securities are overpriced because they're too easy to invest in. So, but by implication, private investments are not overpriced. But if everybody hears that and everybody responds and everybody dumps their public securities and buys in the private markets, then maybe the inflow of capital from the private markets makes the private markets makes private investments too expensive, and their desertion of the public market makes those too cheap. So there's no rule that always stands. And when everybody says the secret to getting rich, the secret to superior risk-adjusted returns is to make private investments, if everybody believes it and all the money flows to private investments, then it will no longer be underpriced and attractive.
Hi, Mr. Marks. Thanks a lot for speaking to us. My name is Alex. I have a quick question. So how do you distinguish between minding the cycle and market timing? Because everyone says, you can't time the market, but it seems like just want to hear your take on it.
Well, that's a great question. And my initial reaction is to say, okay, you got me. Because, and the reason I say that is one of the 6 tenets of Oaktree's investment philosophy is that we're not market timers. But I do think that the way I try to weasel out of that vice that you put me in is that I think that market timing means raising and lowering cash based on a prediction of what the market's going to do. And we don't usually raise or lower cash, and we never make a prediction of what the market's going to do. And what both my first book, The Most Important Thing, and the second book, Mastering the Market Cycle, say on the subject is we never know where we're going, but we sure as hell ought to know where we are. I do not believe in forecasts. And, you know, my hero, John Kenneth Galbraith, said we have two kinds of forecasters, the ones who don't know and the ones who don't know they don't know. So one of the tenets of Oak Tree's philosophy is that our investment decisions are not driven by macro forecasts. We don't have an economist on staff. We don't invite economists in to tell us what GDP is going to do next year. We base our decisions on where we are in the cycle of that business, in the cycle of the economy, in the cycle of the market, psychology, and attitudes towards risk, and in the capital market cycle. There are a lot of cycles that bear on our decisions. We try to have a sense of where we are. Very important, but everybody recognize the book is fully open on this subject. Knowing where we are doesn't tell us what's going to happen tomorrow. Because for example, as we've seen in recent months, from any point on the cycle, the market can go up, down, or flat. The fact that securities are overpriced doesn't mean they're going down tomorrow. The fact that they're underpriced doesn't mean they're going up tomorrow. From any point on the cycle, they can go up, down, or flat. Does that mean that all three are equally likely? No. Where we are in the cycle determines the odds, or what I call in the book the tendencies. And so by understanding where we are in the cycle, I believe we can get the odds on our side, but not provide perfect certainty that we're right. So to me, the distinction is tilting to what we think is the right behavior based on an understanding of where we stand in the market, in the cycle today, as opposed to raising and lowering cash based on predictions of what's going to happen tomorrow. And I hope I've exculpated myself. Tom.
Yeah, in terms of setting up an organizational structure, is there an optimal mix or an optimal structure in both identifying and capturing the market inefficiencies?
In setting up an organization, is there an optimal structure for capturing market inefficiencies? Well, I would say that number one, I think there are more and less efficient markets, and so if you believe everything I said here, I should get this boilerplate off the screen. If you believe everything I said, then it tells me that if you're going to be an active manager, you should try to get into markets which are less efficient, and that they exist, and that you can sometimes figure it out which they are. That's number one. Number two, that means that you should direct most of your efforts at taking advantage of inefficiencies, and you should have people who are contrarians, skeptics, and who tend to think that way. Now, what does that mean, taking advantage of inefficiencies? Well, Mark Twain, I think it was, said that the definition of a profession is a conspiracy against the laity, because professions tend to use big words to describe the things they do, and the academics at University of Chicago came up with this word inefficiencies as the things we should try to capitalize on back in the early 60s. I use the word mistakes. If you can find a security which is underpriced relative to its intrinsic value and relative to other securities relative to their intrinsic values, then what you're really doing is you're finding a mistake. And if you really have done what you think you've done, then that means that the person who's selling you that security is making a mistake. So, do you think that mistakes are made? Do you think that you're smart enough to be the one who finds them rather than the one who commits them? And obviously, in order to find and take advantage of the mistakes of others, you have to have what I call a contrarian way of thinking. My first book, the first chapter in the first book, the first book is called The Most Important Thing. And I would find myself in my clients' offices saying, the most important thing is to not lose money. And then 5 minutes later, I would say, the most important thing is to buy cheap. And then 5 minutes after that, I would say, the most important thing is to understand the risk you're taking. So I wrote this book called The Most Important Thing, and there are 21 chapters, and each one starts off, the most important thing is, and then it's a different thing. Because there are many, many things in our business which are not only most important, but absolutely essential. And you have to do them all. It's like a brick in the wall. You can't dispense with any of them. But the first chapter says the most important thing is second-level thinking. If you think the same as everybody else, you're going to act the same. If you act the same as everybody else, you're going to perform the same. And that's not a very good performance formula for being a superior investor. If you want to be a superior investor, you have to think different from others. You have to act different. And maybe then you can have different performance. And then the only question is your performance different and right or different and wrong relative to the average. But clearly, if you think the same as everybody else, you can't outperform. So you have to have an organization which is based on what I consider second-level thinking, which is thinking different from others and better. So when my son was studying investing, and he would come to me and he'd say, Dad, I think we should buy Ford stock because Ford is coming out with a great Mustang, and they're going to make a lot of money. And I would say to him, my answer was always the same because I feel by repetition you can get your lessons across. So my answer to him was always the same. Who doesn't know that? If Ford's going to come out with a great Mustang and it's going to be a killer car and it's going to make a lot of money, but everybody who follows Ford knows that, then that piece of knowledge is not profitable. So in order to outperform others, you have to know something they don't know. You have to look at things in a different way than they look at them. Second-level thinking, different and better. And just one brief example. The first-level thinker says, this is a great company, we should buy the stock. The second-level thinker says, it's a great company, but it's not as great as everybody thinks, we should sell the stock. And that's the thing I hope you'll think about. Yes, there's one over there.
Yeah, hi, my name is Gene Coleman, and I would like to ask you a question. It's only your personal opinion, if you can answer it. Do you think Fed will raise interest rates? If yes, how many times this year and next year? And what do you think GDP will be this year and also next year? Only based on your opinion. I don't really care about anybody else.
Well, you might have missed the part when I said I don't believe in forecasts. Not only do I not believe in forecasts, I especially don't believe in my own. I lived through the 70s, and in the 70s, America was victimized by hyperinflation. And at times, inflation was running at 16% a year. I had a loan out from, as it happens, the First Chicago Bank, and it was 3/4 over prime. We didn't have LIBOR then. We had something called prime. My rate was 3/4 over prime. And I got a slip from the bank one day, and it said, your rate is now 22 3/4. So that was the 70s and into the early 80s. And nobody could figure out how to get inflation under control. And, everybody was tearing out their hair, and we had Jimmy Carter, and we had Ford, and we had these things called WIN buttons. WIN stood for Whip Inflation Now. And it turned out that putting on a button didn't do any good. But the thing is, eventually, Paul Volcker was appointed the Fed chairman, and he raised interest rates, and he cooled off the economy, and inflation stopped. And when Volcker was done, when he left office, which I think was 82, and he was considered the smartest man alive, he went to his first event, like this one, and he was asked, will interest rates go up or down? And he said yes. And that's my answer to you. And as I say, I don't believe in forecasts, and especially my own. Now, having said that, 6 months ago, everybody was sure that interest rates were going to go up a lot, fast. And now, because Powell got some worries about the future of the economy, he cooled it with the interest rate increases, and now everybody thinks he's going to be a dove, and he's going to support the market, the economy and the market by not raising interest rates. And the only thing I would say in answer to your question is I think that he will raise interest rates more than people think. That's my guess, because I think there are a lot of reasons why we should have interest rates above today's. So I hope I sidestepped that question.
Hi.
You.
Hello.
Oh, sorry.
Hi. You mentioned that we're in a low return environment, and I can certainly understand that with respect to bonds, because any bond I buy today has a yield to maturity that's quite a bit lower than it would have had 20 years ago. But is that true of stocks? Because stock PEs aren't demonstrably higher than they were 20 years ago. Do stocks and bonds have different cycles, and where are we in each cycle?
Well, on the one hand, of course, they can diverge. But it's easy what you say is about bonds is true. The low returns are wired in. If you buy a 3% bond, you shouldn't expect 6% return to maturity. You might get lucky and have a 6% year, but not to maturity. Stocks, which do not have a wired return, seem on the face to be freer to diverge from their returns, to have a return different from that of bonds. What you say has a lot to recommend itself. The PE ratio on the S&P is 16 or 17 today. The post-war average is 15 or 16. Stocks are not priced much higher than they historically have been, and historically the S&P has produced a return of about 9% a year on average. So is it possible that the 10-year Treasury will yield 2.75 for the next 10 years, but that stocks will return 9? Is, I think, your question, and or 8. And the answer is yes, it's possible. And there's good arguments to be made that that's the case. Now, most people don't think that stocks are set up to return 8 or 9 in the coming decade. I think one of the main reasons being that historically stocks have given 8 or 9, but in the old days, the economy grew faster than it's growing today, or than the outlook calls for. And it seems to me that in the 1945 to 2000 to 95 or 2000 period, the economy grew faster. It had the benefit of the catch-up from World War II, the professionalization of a lot of industries, and a lot of technological and productivity gains that are not going to be repeated in the coming decades. But I might be wrong. There's this theory called secular stagnation, and then there are the people who don't believe it, and I lean to it a little more than I lean against it. So it's true that stocks are not much overpriced relative to history, relative to the PE ratio, but you might be paying a slightly higher PE ratio than history for slightly lower growth than history, which is not that good a deal. Anyway, most people seem to think that stocks will return 5, 6, or 7 in the coming years. But if the 10-year pays 3 and stocks give 5, 6, or 7, that difference of 200, 300, 400 basis points a year is kind of in line with what most people think of as what's called the equity risk premium. So the real question is it going to do 5, 6, or 7 like most people think, or is it going to do 8 or 9 as your reasoning leads to, in which case, if you buy them, you'll be the smartest guy in this room. But you really can't tell. But I guess another way to look at the question is this. If it's true that the 10-year will give 3 and stocks will give 9, then stocks are too cheap. And somebody who believes in an efficient market would say, well, that can't be. So even though it looks to me like stocks will give 9, there must be some trap hidden which is going to prevent it. That's the way an efficient marketeer would think, and maybe it's wrong. Back when I was on the Chicago campus, we used to tell the story about the Chicago finance professor and the student who were walking through the campus arguing about the merits of the efficient market hypothesis. And the student says, oh, look, professor, isn't that a $10 bill on the ground? He says, no, it can't be a $10 bill, because if it was a $10 bill, someone would have picked it up by now. And so the professor walks away, and the student picks it up and has a beer. So the point is sometimes there are discontinuities in the market, and you have a case for why this is one of them, and I can't say you're wrong. Two more. Yes, sir.
Mr. Marks, have you or your team at Oaktree come up with any particularly insightful explanations for the market collapse from October through the end of December?
Yes. Why did the market collapse in the fourth quarter? And the answer is people freaked out. I mean, I don't think anything really changed fundamentally. You know, the book came out on October 2nd, and I started to make a book tour that day. And on October 3rd, everything seemed to be okay. And on October 4th, the market started to go down. And it went down for the next October, December, 2 months. 80 days. And, you know, it was the worst December since 1931. What changed? Well, the first thing I was on the road, so I wasn't getting all the inputs in real time as I normally might have been. The first thing I was told was, well, the interest rates have spiked up, and the 10-year hit 3.25 that day. And my reaction was, but didn't everybody know that higher rates were coming? And why, if it's higher rates, why would they be priced in today but not 2 days ago, since everybody knew they were coming? Number two, they said, well, oil is collapsing. My reaction was, is that good or bad? You know, I mean, low oil prices bad for the oil companies, but great for everybody else, and great for the consumer, and maybe even great for the economy. So is a collapsing oil price really a reason why stocks should go down? Then, of course, there was concern over the possible trade war with China, but that was in the cards for months. You know, so I really don't see anything that changed that much fundamentally from October 3rd to October 4th. And for my views on that subject, I'll refer you to a memo I wrote in February of 16, which in the early 16, the markets got off to their worst start in history. And I wrote a memo called On the Couch because, you know, I said in the memo that once in a while the market needs a trip to the shrink. And I said in the memo, and this is one of the things I hold most strongly, and this is my only explanation for the fourth quarter, is that in the real world, things fluctuate between pretty good and not so hot. But in the market, investors go from thinking that the outlook is flawless to thinking that the outlook is hopeless. And that's what happened. I can't tell you why they did it. Maybe things were like, you know, I had that list of things. Where is it? It was like the first slide. I had that list of things that incorporated positive expectations, and maybe some critical mass of investors said, you know what, maybe we've been too positive. And they turned negative. That's all I can tell you. Doesn't make any sense, but that's what the market does. Oh, by the way, so I put out that memo on a Thursday, and on the next morning, I went on Bloomberg to talk about it, which is what I usually do when I put out a memo. And they kept saying to me, well, the market is down. Isn't that a sell signal? The market's down. Isn't that a sell signal? And so I ran back to my office. I wrote another memo entitled, What Does the Market Know?, which I put out, I think, 3 days later. And the market doesn't know anything. The market is just made up of a bunch of people. And it is not any smarter collectively than the people are individually. And the people went freaked out. By the way, what were the reasons for the declines in February 16? Anybody have a good memory? Interest rate rise, oil prices down. And then there was a fund called the Third Avenue Fund that melted down. And it turned out that they had a portfolio of illiquid credit investments, but had promised liquidity to their investors, which is a combination that often ends in sorrow. But it was quite similar. And you know, the point is, anybody who takes his buy and sell signals from the market, which is to say, if prices are up, that means it's a buy, and prices are down, that's a sell, I think is really nutty. Because, you know, the point is, as my idol Warren Buffett says, I like hamburgers, and I eat more hamburgers when they're on sale. And anybody who thinks that low prices are a sell signal and high prices is a buy signal, there's something wrong. So the point is, as the memo, What Does the Market Know, tried to point out, don't count on the market for rationality and don't look for rational explanations. It's all psychology. If you can understand the flaws of psychology, you're in much better shape than looking for rational explanations. Is there one more?
Yes, here. Ms. Marks, I think ever since your book came out last October, I have anecdotal evidence that it has become a consensus in the market when I watch the finance news media, that everybody seems to agree that we are really in the late stage of the cycle. And so that before that, I think I always can hear some people comment, oh, we're early, we're in the middle, but seems right now everybody really is convinced that we're late in the cycle. So that brings me two questions. I mean, if everybody is convinced that we are late in the cycle, wouldn't that awareness of the lateness of the cycle kind of prolong this cycle and make the anticipation of the cycle more challenging? And the second related question is, if this is really true that everybody is kind of cautious, wouldn't that make when the cycle really turns, would that make the market reaction more benign, let's say, versus the last time around? Thank you.
Well, thank you. I said one question. I didn't say two. But anyway, the answer is that if everybody holds a point of view, by definition, it's baked into prices. So if you agree with that point of view, it's not going to make you any money, even if it's right. The goal in investing with regard to understanding the environment or even the future is not to be right. The goal is to be more right than others. And correct forecasts, which are commonly held, don't make anybody any money. So if everybody is now cautious, that's a favorable sign, because that means that expectations are low. And if things come in, if you are more optimistic than the consensus and things come in better than the consensus expects, then you will make money. Of course, the problem is that usually the consensus is about right. So correct idiosyncratic forecasts are potentially profitable but rarely correct. But that doesn't mean you shouldn't try. And by the way, that's one of the reasons why I don't spend a lot of time making forecasts. But I will say one thing about the people and the consensus that we're in the late stages. You'll recall that in December of 17, the government passed a tax bill. And people got very excited. The stock market did very well. And everybody thought that it would be very salutary for the economy. And I started to get emails from people, because we were in the 10th year of economic, at that time we were in the 9th year. And there's never been an economic recovery in the United States that went more than 10 years. And so most people were kind of getting a little cautious about late stages. And then after the tax bill was passed, I started to get emails from people saying things like, Australia has not had a recession for 26 years. And since this is the 9th year, maybe we're going to go 17 more years without a recession, which in my opinion is another form of saying this time it's different, which is the 4 worst words in the world. Anyway, so all these people started to think, well, maybe we're not going to have a recession, maybe we'll never have a recession, maybe it's not going to come for 17 years or 5 years or 10 or whatever it might be. And then, of course, the market proceeded to do very well based on that optimism. And the trouble was that in the 4th quarter, all the people who said no recession for 17 years said next week. And that's why the market did so badly in the 4th quarter. So the point is, as I say, forecasts swing much more radically than reality swings, and it's desirable. So that leads us to the issue of being a contrarian. And it's important to be a contrarian, except that it's not always the right thing to do. And there are a lot of people who say, oh, contrarian. Well, what contrarian means is you do the opposite of others. No. To be an intelligent contrarian, you have to know what others are doing, know why they're doing it, know what's wrong with what they're doing, and then figure out if there's appropriate action to be taken on that. In my first book, The Most Important Thing, had a second edition called the Illuminated Edition, in which some notable investors and I added commentary to the first edition and told people what they should think about what they had just read. And Joel Greenblatt, who was a great equity investor, one of the greatest, who nobody has ever heard of, although he has some books out called The Little Book That Will Make You a Market Genius or something like that. Very good books, and they have the merit of being short. Joel put in, on the section on contrarianism, just because 5 other people will not stand in the path of an oncoming Mack truck doesn't mean you should. So contrarianism is not just a matter of doing the opposite of others, it's a matter of taking advantage of mistakes, and it has to be done on an understanding. And I hope that helps. Thank you for having me today. It's been great being here.